How traders manage their risk. An outline for today's lecture. So these are the following 5 things that I would like to discuss. I begin with more like a qualitative discussion on what risk management for traders actually means. So where should we position that? And traders, we know them as in fact, say, trying to generate profits, trying to sell financial products. But on the flip side, they also need to manage the risk that comes with all their trading. And in particular, when we talk about trading in derivative securities, there is a potential huge risk if the risk is not properly managed. And that has to do with the fact that some of these derivatives have nonlinear relationships to other economic variables. And we need to understand how we are going to measure those risks and then afterwards how we can manage it. And what I will do today is in detail discuss one of these nonlinear derivatives, and that's call options, to show you how actually we could find risk measures for that and how afterwards we can use them. So these risk measures that we define for options, we call them the Greeks, and as it will become clear later is that these Greeks are called the Greeks, these risk measures are called the Greeks because they refer to Greek letters like delta and gamma and so on. And we're going to discuss the Greeks, and we're also going to show you how accurate these Greeks as risk measures actually work. So once all this theory then has been presented in today's lecture, I will move on then to an actual example where you see how traders on a daily basis could manage the risk in their trading book. And as we will see is that, well, risk management or risk mitigation for traders is more complicated than perhaps for some other firms. And that is due to the fact that on a daily basis, if market variables change, then also the position that used to be safe from a risk point of view may have altered, and therefore a new risk position needs to be taken. So hedging means dealing with the risk, mitigating the risk. Dynamic hedging means that you need to do that on a constant basis in order to stay within your risk limits. So if we look to a bank, then very roughly you could divide the activities within the bank in 3 parts. So there's the front office. In the front office, that's where the actual trading takes place. So that's where the bank or the traders facilitate trades by buying and selling, by offering bid prices and offer prices to parties in the market who are interested. Always with commercial activity, there is the need for risk control. And both in the front office and afterwards in the mid office and the back office, there is a role for risk management. So at least in the front office, what will happen is that these traders, they will engage in all sorts of financial products with counterparties, but at the same time, on that individual level, they have to respect risk with respect to some of the market variables that are around there. So these limits, these risk limits, have been internally imposed upon them by the bank, by risk control, and they have to stick within that. And this is actually, so the front office, so where all the trading takes place, and where then also the risk control needs to take place, that's the discussion for today. So how do traders do that? How do they stay within their risk limits? So you need to then figure out a way to measure risk, and then afterwards a way to manage risk. So then second of all, there is the middle office. And the middle office doesn't look to risk from an individual point of view, but the middle office looks to all the risks aggregated at the bank level. And there is, of course, an advantage in doing that, because then not only do they see concentrations of risk, but they also see diversification benefits. And that's in the end, of course, an advantage to the bank. So at the middle office, the people are actually concerned, the risk managers there are actually concerned with the capital requirements. What we will see in a later lecture is that capital requirements are imposed upon banks by the Basel II, Basel III, and now it is Basel IV regulation. And the middle office assures that the available capital is always in excess of the required capital. And the required capital is a result of a risk assessment of all the financial assets in the book of the bank. And then finally, the third part of a bank, if we are in particular concerned with the risk organization, is the back office. And in the back office, really there is the record-keeping function present and the administration of all the activities. So, very stylized what's happening in the front office. So there in the front office, there's the trading office. So that's where the bank, the financial institution, has the market-making function. Market-making means that whenever there is a counterparty that wants to trade, that has a need to buy or sell a particular financial asset, the bank, as a market maker, will engage in such, will be open for such a trade, and will quote a bid price or an ask price to reflect against what price it's willing to do this. So what happens if a bank does this on an active basis? Then, of course, the investment book of the bank builds up with all sorts of financial assets that it is involved with. And, well, with that huge banking book, investment book of financial assets, comes also the risk that it may potentially change in value. So it takes a lot of positions in derivatives, long positions, it buys derivatives, short positions, it sells derivatives to counterparties. It gets engaged in buying your assets, for example, stocks or in currency trades, etc. And all this together, this trading book then has, as a result, has a particular value, because whenever you buy an asset, you have to pay a price for it, so the asset has a value, and when you sell an asset, you receive a premium. And you have, with options, you have then the obligation to afterwards execute the option if desired. So what happens is that this trading book then actually may build up a significant value, and not only a significant value, but also there is the risk that this value may change over time. And in particular with derivatives, there is the concern that changes in derivatives values may be significant, even on a very short-term basis. So that's why the management of the trading book, the risk management of the trading book, is vital in order to prevent large swings in the value of the trading book. So there's a potential large volatility for the derivatives value, and that's something that needs to be controlled. So how are we going to do that? So I'm slowly building up to the mathematical representation of this risk management challenge. Well, to begin with, what we need to do is we need to be able to measure the value of all the financial assets, but not only the value, but also the value changes, the potential value changes of these assets. So we need to understand how do we determine the value of the total trading book and of the individual components in there, and how do we describe, how do we model the potential value changes. So what are the driving factors for potential change in the value of the trading book? Once we know that, so that's a challenge in itself, once we know how to measure the value and the potential value changes, then we can begin with managing the risk. And that will be the second part, or the last part of today's lecture. So with linear derivatives, hedging risk is relatively easy, and we also say that, well, once you have done that, you can pursue it as a hedge and forget strategy. So if there's a risk with a linear product, and I mentioned here forwards, futures, and swaps, that's the ones that we discussed earlier. Once we have managed the risk with these derivatives, then we are fine. So we can find a hedging strategy that you put into place, and then that hedging strategy will remain. So we call these linear products, and with linear products, there is a hedge and forget strategy. You're fine. Alternatively, everything that has to do with nonlinear products, and when I talk about nonlinear products, you should think of options, as we will see in a minute, then it's not the case that there is a hedge and forget strategy. In fact, what we need to do is we need to continuously measure the risk and also manage the risk. So as market circumstances change, then also the risk measures change, and then also the hedging strategy should be adapted. And that's what we will call a dynamic hedging strategy. So the challenge to risk manage a trading book is in particular in those elements that concern the nonlinear parts of the trading book. And of course, you hedge the trading book as a whole. But the challenge is with the options, the challenge is with the nonlinear derivatives, the options, and that's what we will discuss in more detail. So, once more, if you think of risk management, and you think of risk management in the context of a trading book, then it's not only about the value of this trading book, but it's in particular about the potential value changes. So how could the value of your trading book change even over a very short period of time? And as we will see, is that because derivatives have such a huge sensitivity for changes in market variables, the frequency at which we need to assess risk control is at least at the daily basis. So every day, at the end of the day, we need to reassess all the risk exposures of a trading book, and then afterwards see how to manage it. So that also then points out, say, that there is a huge volatility potential risk in that trading book. So how are we going to do that? As I said, nonlinear relationships make it difficult to find a proper hedging strategy. So what we're going to do, we humans, we better understand linear relationships between the value of, for example, an option and the value of an underlying market variable. So what we will do is we will take this nonlinear relationship between the options and the most important market variables, and then subsequently we will linearize that by using a Taylor polynomial expansion. So that's where the mathematics come in, and we will also then see, well, how that then actually helps us to define the risk measures and then to control the risk. So the trick is going to be a nonlinear relationship which makes it hard to do risk management and make that nonlinear relationship approximate that nonlinear relationship with a linear relationship. So we look to the particular case of call options. There is a very similar story like this for put options that I will not discuss today, but it follows exactly the same lines. What I will begin with is with the valuation of a call option. And there's a very famous formula for valuing call options, and that's the Black-Scholes pricing model. And the Black-Scholes pricing model basically assumes a couple of relationships that approximately hold, but then result into a nice formula that actually works very well in practice. So the quality of the theory is confirmed by its applicability in practice. So let's see how that works. So the Black-Scholes model assumes that the underlying stock of an option has a return that we can model as a continuously compounded return. So that means that we take the logarithm of the underlying asset at time capital T, and we divide it by the value of the underlying asset today at time 0. So that's not a discrete return, but it is a return with continuously compounding. So you take the exponent to determine the effect of the return. So we look over a time period from today, time 0, to some time in the future, time capital T. And time capital T is also exactly the moment where the option will mature, where the option either will be exercised or will finish with a value 0. So this return, we assume, or Black and Scholes assume, that that's normally distributed and that it has a mean with a parameter mu, which is, for example, 10%, and which is then multiplied with the length of the period, time capital T. So if that's 1 year, then you multiply with 1. If it's 4 years, you multiply with 4. And it has a variance of sigma square, which also is a percentage, and then also times the time period. So that's the basic assumption of the underlying dynamics for the stock return. So that's, in a sense, a way to represent the uncertain future for the underlying stock. The call option is a derivative security of this underlying stock. So that basically means that if the stock changes, and we have now a presentation of how the stock could change, then also the value of the call option at maturity will change. There is some more notation that I will incorporate here. So there is the risk-free rate, the risk-free interest rate, which I will denote with RF. There is the exercise price of the call option, denoted with capital X. There is the maturity time, time capital T. I assume, for easiness, that there is no dividend payments. So everything that we do, we could also include dividend payments. It makes the formulas slightly complicated, and you also have to account for the moment where actually dividend payments take place. And then there is also a capital N, which we need to introduce, and that's a cumulative normal standard normal distribution, and that's evaluated in the value X. And as you will soon see, is that this cumulative normal distribution value will reappear very frequently in everything that we do. If we want to calculate it in Excel, there is the norms dist function. If you need to apply it, for example, at an exam, written exam, then there is a lookup table where you could simply look up the value X, where you input the value X, and then see what the number N is going to be. But it's a standard cumulative normal distribution function. So what's the idea behind valuing a call option? The idea is, well, I know that with the uncertain stock development, the uncertain stock return, which is normally distributed, that at maturity time, the stock price could assume many different values. Therefore, the call option at maturity may also assume a lot of different values. And now the question is, if you know that there are all these different values for the call option at maturity, could you sort of summarize that in a single number that you would be prepared to pay today? To say, well, I would find that a fair price, a fair price to pay today, to be exposed to such a payoff with a number of very favorable outcomes and some unfavorable outcomes. And that's exactly what this formula does. So, in the formula, the C0 is then the call price, or the premium that you have to pay if you go long in a call option at time 0. Time 0 is today. So what would I be prepared to pay today in order to have all these potential future payoffs? And the value that arises there at time 0 is that it says, well, what I need to have to determine that value, I need to have the stock price of the underlying asset at time 0, that's the S0. I need to multiply that with a cumulative standard normal distribution function, capital N, evaluated in a value D1. Then I subtract from that the exercise price, X, which I discount with the risk-free rate to today. So it says the E for exponent and to the power minus RFT. So if I use continuously compounding, then compounding and discounting, you apply the E exponent to do so. So here it says, well, you are going to discount back to time 0 from time capital T, and in order to do so, there is the E for the compounding or discounting in this manner. The minus sign says I'm going to discount. The RF is the risk-free rate, and because it's over a time period of time capital T, I need to multiply with T as well. So it says X times E to the power minus RFT is the discounted value of the exercise price, which normally would be paid at time capital T, but now I want to have its present value at time 0. And then this value I multiply again with the cumulative normal standard distribution function, which I evaluate in a value D2. So these values D1 and D2, they again are functions of the stock price at time 0, of the exercise price of the option, the risk-free rate, the volatility of the underlying stock, the time to maturity, and it's complicated formulas there. And so what you see here is that once I know the characteristics of the option, so I know the exercise price and I know the time to maturity, and I know the risk-free rate and the volatility of the option, then that allows me, those are the elements to determine the value of a call option. Please note one important thing is that the expected return of the underlying stock is not relevant to determine the price of the call option. So it's only the risk-free rate. Then if you look to this formula, you see that it seems like there is a linear relationship between the value of the call option at time 0 and the value of the underlying stock at time 0. That's not really true because there's also the multiplication with the ND1 and afterwards with the ND2. And that's also where you see reappearing in the D1 and the D2, there's reappearing the underlying stock price. So I take a nonlinear function, the cumulative normal distribution function, which I evaluate in a logarithm of the underlying stock and more things there, which makes this relationship between the call price and the underlying stock highly nonlinear. And the same applies if I look to the sensitivity for the risk-free rate. Again, it appears in the D1 and also in the D2. So you evaluate it again in a nonlinear function. So also with respect to the risk-free rate, this is a highly nonlinear relationship between the call price today and the risk-free rate. Same applies for the volatility. So basically it applies for everything. So that means that if stock prices or the volatility of the underlying stock return or the risk-free rate change, that the impact on the value of the call option also changes, but then in a nonlinear fashion. So that makes it difficult for us to have an idea, say what actually the impact is of changes in these underlying market variables. So what we will do, so here I once more say, so well, this underlying call price is then that nonlinear function of these important market variables, the stock price, the volatility of the underlying stock return, the risk-free rate, and I also put the remaining time to maturity in there. So that relationship is nonlinear, which I find difficult to assess. For us, it's difficult to get a good idea of, say, what that means. So what we will do next is that we're going to make that relationship better understandable by applying a Taylor polynomial expansion to approximate that highly nonlinear relationship between the call price at time 0 and the underlying market variables, to approximate that with a linear quadratic term. So what does that look like? Well, the C delta T is the value of the call option at moment delta T, so I jump just slightly in the future. Maybe delta T is 1 day in the future. and C0 is the call option value today. So I look to how does the call value change from today to, for example, tomorrow. That's what C delta T minus C0 means. I look slightly in the future. And this change, because we are interested in potential changes of the underlying call option, are related to changes in the stock return, because here it says the stock price at time 0, and then it also says the stock price a little bit later, maybe 1 day later at delta T. So how does the stock price change over 1 day? And we need to multiply that, pre-multiply that with a partial derivative, the Dow C over the Dow S, evaluated in the current stock price. Because changes in the stock price are so important and have such a big impact, there's also a quadratic term that we take in the Taylor polynomial. So you see the S delta T minus the S0, but then squared, so that's the second order effect. So that also then takes account for larger changes in the underlying stock price. Again, S delta T is the stock price at a later moment in time, so at moment delta T later, maybe 1 day. S0 is the stock price today, so I look to the change in the stock price, but I square that now. And I need to pre-multiply that with half of the second order partial derivative of the call price with respect to the underlying stock price, and evaluate it again in the current stock price. So these first two elements, they deal with a better understanding of the sensitivities that a change in the call price has with respect to changes in the stock price. We try to approximate that by a linear change term and a quadratic change term in the underlying stock. Then there's other market variables that may be important for the changes in the underlying call price, and that's the volatility of the underlying stock return. So that's the sigma. So we have the sigma as it is today, sigma 0, and the sigma, of course, could change. The returns of the underlying stock could become more volatile, could become more uncertain. So that could be then be sigma delta T. So again, 1 day later, perhaps the volatility of the return is larger. And we want to see what the impact is of that on the change in the potential change in the call price. And to do so, we need to pre-multiply that change in the volatility with the partial derivative, the Dow C over the Dow sigma, and then evaluate it in today's value of the sigma. And then the same thing applies for changes in the interest rate, which is the next term. And then as a final term that you see there is that even if nothing happens, because time passes and the option every time comes closer to maturity, there is an effect in itself on the call price. So that's something that you cannot change because you cannot stop time from passing on. But still what we do is we call it sort of a risk measure to get an idea of, well, what is anyhow going to be an element of change in the underlying call price. So we look to a change in time, delta T, and we multiply that with the partial derivative of the call price with respect to time. So that's the Dow C over the Dow T, evaluated in today's time. And this gives me then a linear quadratic relationship between changes in the call price and changes in what we think as the most important underlying market variables. And because this relationship is so important, and because these partial derivatives look so ugly, so if you see them like that, they have come to introduce Greek numbers, Greek letters for these partial derivatives. So the Dow C over the Dow S evaluated in today's stock price, we call that the delta. So the delta is a risk measure which tells you what the sensitivity is, the linear sensitivity is of a change in the call price because of a change in the underlying stock. Then there is the gamma, and the gamma looks to the quadratic change of the underlying call price with respect to the underlying, looks to a change in the call price, a quadratic change in the call price, because of a second order term with respect to volatility. So that takes account for larger changes in the underlying stock price. So it takes account for the quadratic element there. Then there is the sensitivity for changes in the underlying volatility. We call that vega. We write a capital lambda, but we call it vega. Then there is the risk sensitivity for changes in the underlying risk-free rate, which we call rho. And then there is a risk measure for changes in the change of time, which we call theta. Important to notice, the Taylor approximation and the risk measures that we have adopted assume that we look to a very small time period. So we look to changes in a time period of, say, either, we would say instantaneously, or maybe one day. So not over longer time periods. So the Taylor approximation works well simply because we look to a small time period where changes cannot be too high. If we allow for a longer time period, then the linear and quadratic approximation may not be valid anymore. So small time period changes. And that also says, well, if the market variables then change significantly, you will see that these risk measures, the delta, the gamma, the vega, the rho, and the theta, no longer apply, but have to be recalculated, and then a different hedging strategy has to be adopted. The risk factors, well, we have mentioned that already a couple of times. We look to the underlying stock price, the volatility of the underlying stock return, the risk-free rate, and time. And once more, the expected return of the underlying stock price, is not a variable. So we are not sensitive for changes in the expected return. Another thing which is important if you look to this relationship is that the underlying stock price is a prominent risk driver. It has a huge effect. So that's also the reason why we not only look to linear effects of this variable, but we also adopt quadratic effects. So there's the first order term, the delta. There's also the second order term, the gamma, to do this. So these Greeks are risk sensitivities, and these are risk sensitivities only for small changes in small time intervals. If there are significant changes in these in the underlying variables over longer time periods, then both say the fact that it's larger changes over a larger interval implies that the quality of the risk measures is poorer. They work best if you look to high frequency, there's small intervals and small changes. So be aware of that whenever you see huge changes, that maybe your interpretation of the risk measures are not as accurate as you may assume them to be. So let's go one step further, because we saw the Taylor approximation, and that's where the risk sensitivities were represented by the partial derivatives of the call price with respect to the underlying risk variables, with respect to the underlying stock, the risk-free rate, volatility, and so on. But given that there is the Black-Scholes price for the underlying call price, we could actually pursue the calculation, finding the mathematical forms of these risk variables, of these partial derivatives. And in the appendix of the book of Hull, these formulas are exactly given. And I've written them down here for the case of a call option, and I left out the dividend part that is in these formulas. So the Greeks are here for non-dividend paying call options. And then what you see is that the delta is the capital N D1. The capital N is the cumulative normal standard distribution. That's also an element that appeared in the Black-Scholes formula, and you evaluate it in D1, and the D1 is also this element that appeared in the Black-Scholes formula. So we could do a mathematical calculation for this first risk sensitivity for the delta. Same with gamma, which is the second risk sensitivity, which allows for a risk measurement due to larger changes in the underlying stock. So there we see that the mathematical formula for this risk measure is the n prime d1, which means the derivative of the cumulative normal standard distribution, and divided by the underlying stock price today, the volatility of the underlying stock return, and the time to maturity square root. So these are, again, all elements that appear in the Black-Scholes formula itself. The n prime d1, so the derivative of the cumulative normal standard distribution, is simply the standard normal density function, and it's at the bottom of this slide. So it's standard normal, so it means that the mean is 0 and the standard deviation is 1. So it's 1 over the square root of 2 pi, and then times e to the power minus half x squared. And it will appear a couple of other times in other formulas, so we need to have that right. So then the vega, which is the sensitivity risk measure for changes in the volatility. Also there you see all variables that were already known from the Black-Scholes formula, the stock price today, the time to maturity of the option, the n prime d1 again, so which is the standard normal density function evaluated in the d1, and the d1 was an element in the Black-Scholes formula. So there's the rho, also again a risk measure, but this risk measure measures the sensitivity for changes in the risk-free rate over a short period of time. We see reappearing in this formula the exercise price of the call option, the time to maturity of the call option, discounted with the risk-free rate 2 times 0, times ND2, which again is an element in the Black-Scholes formula. There's the theta, and so in a nutshell, all the variables that were applied in calculating the value of the underlying call option also reappear as values in the measurement of the underlying risks that are available. So the risk sensitivities are based on exactly the same variables, and you see very often that you see parts of that Black-Scholes formula that was used for the valuation. Parts of that also is then used to describe the risk measures. So important, not only one risk measure, but multiple risk measure, underlying stock, volatility, risk-free rate, and not really a risk measure, but well, an impact on change value, the remaining time to maturity, measured by theta. So let's look how well this linear quadratic Taylor approximation works. What I did here on the upper left, there is what I've called the base case. I look to a stock which today has a value of 49, and I look to a call price which has an exercise price of 50. The risk-free rate in the market is 5%. The volatility of the underlying stock return is 20%, and the remaining time to maturity on this call option is 0.38. So if I'm going to determine the value of this call option, I first need to determine the D1 and the D2, which are elements in the Black-Scholes formula. Simply filling out these formulas gives me intermediate values for D1 and D2. And then in the end, the C provides the value of the call option at time 0, 2.4. That's the original call value. Then say one block to the right of that, it's where I say change. And what I did there is that I said, well, let's assume that all variables stay the same, but that there is an instantaneous change in only one variable, and that's the underlying stock price. So the next second, or even less than a second, the underlying stock price changes from 49 to 50, and all the other variables remain the same. So what I will do next is that I will say, well, let's first see what the exact change is of that, by reapplying the Black-Scholes formula and comparing it to the original value. And then second of all, what I will do is I will say, well, let's see if I want to approximate this change in call value with the Taylor polynomial using the Greeks, which are at the bottom. But first, now, I need to calculate again the value of the call option with now a stock price of 50 instead of 49. Exercise price remains 50, risk-free rate remains 5%, the volatility remains 20%, remaining time to maturity 0.38 years. The D1 and the D2, they change because of the change in the underlying stock, and then the new call value will be 2.95. So what I see is originally in the base case, the value of the call was 2.4. There is a change in stock price, instantaneous, from 49 to 50, which is a small price increase. And as a result, if I reapply the Black-Scholes formula and I calculate again the value of the call price, it's 2.95. So then the exact change in value of the call is 2.95 minus 2.4, the new call value minus the original call value, which is a change of 0.55. So that's the exact way, the precise way of calculating the change in the value of the call, simply by applying 2 times the nonlinear formula, the nonlinear Black-Scholes formula. So the question is, well, given that I want to have a better understanding of how the risk measures work, and so that I also then have a linear relationship, I'm going to determine the Greeks in the base case. Those are the delta, the gamma, the vega, the rho, and the theta in the left corner side of the table. So using the formulas that were on the previous slide, which gives me a delta of 0.522, a gamma of 0.066, a vega 12.105, rho 8.907, theta minus 4.305. So these are the risk sensitivities for small changes. Now I go to the third column, which at the bottom, which says change. And what happens is that there was a change in stock price. The stock price changed from 49 to 50. So I need to do 50 minus 49 is 1. So the change in relation to the risk sensitivity of the delta is 1. And in the relationship of the gamma is also 1 to the power 2, and 1 to the power 2 is also 1. So there are 2 changes which affect a change in the price of the call option. So there is no change in volatility, risk-free rate, or remaining time to maturity, because we assume that the relationship, the change, was instantaneous, so there was no time passing by. So that means that all those changes, the remaining 3 changes, are 0. So now, how do I determine the effect of this change in stock price using the risk sensitivities, the Greeks, the delta and the gamma in this case? I take the delta, which applies for the base case of 0.522, and I multiply it with a change of 1, which gives me 0.52. And I add to that half times the gamma of 0.066, and I multiply that with 1 square, which is 1, which gives me 0.03. So if I add these 2 effects up, I get 0.55. So as a result, what it shows is that with a small change in price, so the stock price goes from 49 to 50, the delta and the gamma turn out to be good risk sensitivities, because I see that I could properly represent the changes by this Taylor approximation, because I arrive at with the approximate Taylor results at exactly the same change in the underlying call option of 0.55 as I did with the exact formula. 2 other things which are relevant when you look to this table. First is that you see that the change in the stock price is small, goes from 49 to 50, and then the dominant risk effect is picked up by the delta. So we see that the effect is 0.52 when we look to the delta, and the gamma, it's only 3 cents. It's because I'm going to square a change, and so when the change is a small number, then the effect is not huge. We will see a little bit later that when the changes are bigger, then this effect of gamma becomes very dominant. But here, you might have gone as far as say, well, given that the change is small, the dominant effect is picked up by the delta, so I should not be concerned about the gamma because I'm reasonably accurate already assessing the risk if I would only look to the delta. So that's the first remark that I have. The second remark that I have is that there is only a very small change in stock price, but at the bottom, in the middle, so under the column change, I also recalculated the risk sensitivities, and you could compare them then to the risk sensitivities of the base case. And you see that even with a small change in stock price, the values of these risk sensitivities have already changed. Not dramatically, but still they have changed, which means that the risk sensitivity for changes in the underlying stock, for changes in the volatility, for changes in the interest rates, for changes in time, are different now than they used to be in the base case. Which also means that if these changes are significant, it means that your risk profile has altered, and it means that you may want to engage again in a different hedging strategy to mitigate that. We take exactly the same example as we have before, so nothing has changed to the base case. So we have exactly the same call option that we price at a value of 2.4. The risk sensitivities are exactly the same. The only thing that changes now is that instantaneously, so in the very next second, the stock price changes from 49 to 55, which I call a large price large price increase in the underlying stock. So at the middle top, I then recalculate using the Black and Scholes formula the new call price, which is the exact determination of the call price. So I have to fill in the 55, the exercise price, risk-free rate, volatility, and remaining time to maturity remain the same. But because of this change in stock price, which is huge, also the D1 and the D2 change significantly, which also means that the call price changes significantly. So with an increase in the stock price of 5, we see that the call option price changed from 2.4 to 6.57, which is enormous. That's like 300%, 300% change. So the exact change there is 4.17. So now the question is, this exact change that I've calculated at the top, would my risk measures, the Greeks, would they have been sufficiently accurate to pick up that change as well? So is that Taylor approximation, is it sufficiently accurate that I can apply these Greeks as risk measures? So we have the risk measures at the bottom left, so the delta, gamma, vega, rho, and theta with the base case. And I'm going to fill in the third column at the bottom, I'm going to fill in the changes again. So the stock price changes in value is now 6, so which I should then take as a change in relation to the sensitivity for the delta. But now, given that this change is so significant, I also take the second order term, which is 6 square, which is 36 in this case, which I now need to multiply with half times the gamma. So if I look to the combined effect of the two, I see that the impact, the linear change, is then the 0.522, which is the delta of the stock in the base case, multiplied with the change, the linear change in the stock price of 6, which gives me an effect of $3.13, and the quadratic term, the gamma, a sensitivity of 0.066, which I multiply with half times the change in the stock price square. Stock price square, 36. So that means that the combined effect of these two is $1.18. So where we saw in the previous case that with small stock changes, the effect is maybe only 3 cents or so, with larger stock price changes, we see that there is a significant impact. So it is important to have the second order Taylor polynomial because it contributes $1.18 to the change of value. So if I add these changes up, so the combined effect, I get a change in the value of the call option of 4.31, which I could compare with the exact value of the call, which is 4.17. And you see that it's actually still very accurate in terms of approximating the risk for large changes in the underlying stock. So this is an enormous change in a very short time period. So if you then still approximate it this precise, it's good. So 2 remarks. The first remark is we see that the gamma, so the second order term with respect to changes, larger changes in the underlying stock becomes relevant, is important. We see the contribution of $1.18 to that change. And the second thing that is relevant is that, again, is that there is this nonlinear relationship with the risk measures, and as soon as the market variables change, then also all the risk measures change. And that's what we see in the bottom middle when we look to the delta, the gamma, the vega, the rho, and the theta in the change column. So we see that the delta has changed from 0.522 to 0.838. So there is a different sensitivity now for underlying stock price changes. And also all the other sensitivities are different, which means that my risk exposure has changed because of this change in stock price. And if I want to manage my future risk, I should take care of this change. So it's not only the call price that has changed from 2.4 to 6.5, but also after the change, the sensitivities, the risk sensitivities for future changes have also changed. So I also then need to reassess my risk hedging strategy. So as a third example, I look to potential changes in the underlying volatility. So again, base case, everything the same. In the change column, top and bottom, I only change the volatility, which now moves from 20% to 25%, which is a significant change if that happens instantaneously. I could again do the exact calculation with the Black-Scholes formula. We see then if I do that the call price changes in value from 2.4 to 3.01. So the exact change is 61 cents. If I look to the approximation using the Taylor polynomial, I have to apply the Greeks again, which are in the base case bottom left. So the relevant risk sensitivity now has become the vega, which is 12.105, which is the only risk sensitivity that's relevant because there has only taken place a change in the underlying volatility. So that change is 5%, 0.05. All the other changes of the risk variables are 0. So I need to multiply the vega, 12.105, times the change of 0.05, which gives me 61 cents. So you see again that the exact change, which is at the top of 60 cents, almost 61 cents, is very well approximated by this Taylor polynomial. So the vega as a risk measure works well for instantaneous changes in the volatility. And then again, the remark that reappears every time. So if one of the market variables change, then not only the call price changes in value, but also the risk sensitivity for future changes in the underlying market variables, they change. And that's what you see here when you compare the Greeks from the base case with the Greeks in the alternative case. Sometimes it's not very significant, but still it's there. We look to changes in the risk-free rate. So all the variables remain the same, only the risk-free rate changes from 5% to 8%. 300 basis points increase instantaneously, that's a big change. Using the exact calculation, we see that the call price changes from 2.4 to 2.68, which is a change of 28 cents. If I want to use my risk sensitivities, the Greeks, to see if I could also approximate that with a linear quadratic relationship. Then in this case, I need to take the rho as a risk sensitivity measure of 8.9. I need to take the rho in the base case. And I multiply it by the change in interest of 0.03. And if I multiply that, then I arrive at 27 cents. So I see that the 27 cents with the Taylor approximation is very close to the 28 cents of the exact change in call value. So again, reconfirmed. Also the rho as a Greek, as a risk measure for the underlying changes works if we look to small changes in small time intervals. Then what happens if nothing changed but we just move on one day? Then the remaining time to maturity moves from 0.38 to 0.37, and we see that the call price actually increases in value from 2.4 to 2.58, 18 cents. Again, if I want to use the Taylor approximation, I want to use the Greeks, then the theta is the relevant sensitivity measure. I should be careful not to call it a risk measure because passing time that moves on is not really a risk. It's simply something that will always happen. So it's anyhow a given that the values will change. So then I see here the combined effect actually of the change in rho and the change in theta, which gives me both 18 cents. So what we have done so far is that we have said, well, let's look to a description of the value of nonlinear derivatives, and let's see if we could model the value change of that nonlinear derivative with a Taylor approximation, and associated with a Taylor approximation, could we introduce risk measures? And we have done that, the delta, gamma, vega, rho, and theta. And the question is, well, if we are able to do that, how could we then afterwards also use these measures to manage the risk of the trading book? Well, it's in fact quite easy. So we are not going to look now to a single call option, but we're going to look to a trading portfolio which has many options in there, calls, puts, underlying values, all sorts of other things. And instead of calculating the Greeks now only for one call, we calculate the Greeks for all the securities that are in the trading portfolio. And then, of course, we could add them up. It's as easy as that. One important remark here is that if you look to the underlying stock price, the underlying stock price has only one risk measure, well, at least one Greek risk measure, which is the delta, because if I take the partial derivative of the underlying stock with respect to the underlying stock, then the value is equal to 1. So the delta is 1 for the underlying variable. If I take the partial derivative of the underlying stock with respect to risk-free rate, volatility, time to maturity, second order partial derivative, these values are all 0. So there is no risk sensitivity for the changes in the underlying stock if volatility, risk-free rate, or time to maturity changes. So all the other Greeks are 0. So if I'm going to determine the Greeks of my entire portfolio, my entire portfolio has a value of capital pi, and so we are not only concerned or interested in the value of that portfolio, but we are in particular interested in potential changes of this portfolio, the delta pi. Then we're going to add up all the risk sensitivities that we have calculated individually for each security in the portfolio. And so the sum of all these individual deltas gives me the delta for the portfolio, and is actually a measurement that says, well, by how much would the total portfolio value change when there is a small value in the underlying stock. And the same applies when I add up all the gammas of the individual securities in the portfolio. I get a gamma for my portfolio, and this gamma says, well, what is the second order effect if there is a small change in the underlying stock, which I then need to square and I need to multiply by a half to appreciate what larger changes will be, and so on. So the whole same story that applies on the individual security level then also applies on the portfolio level by simply first determining the Greeks for each individual security in the portfolio and then add them all up. That gives me the Greeks for the portfolio. So once more, the value of the portfolio, of the trading portfolio, I denote with capital Pi, and a change in that portfolio I denote with delta pi. And of course, I'm interested in the delta pi, which is a potential loss that I could bear. So what could you do as a trader? You could say, well, I'm looking to my Greeks, and of course, it's uncertain what future changes are going to be. I cannot predict it, I cannot foresee that. But what I could do, I could say, well, given that I have a particular risk sensitivity right now for a particular underlying value, I could see if I could change that risk sensitivity. So what do I mean? I mean, for example, I determine the delta of my portfolio. I judge that delta of the portfolio, and I may say, well, hey, seems that that's a large sensitivity for changes in the underlying stock price. Then what I could do is I could add to my portfolio more underlying securities, which all have a delta of 1, and I could do that in such a way, I could short them, for example, that I overall get a new portfolio where the delta is smaller. Let's say even you try to make it to 0. So if I adjust my portfolio in such a way that I change the risk sensitivities, so I have an original delta, but I add to my portfolio other securities to make my delta equal to 0, then with the delta equal to 0, it doesn't matter anymore, say, if there is an underlying whether there is a change in the underlying stock price. Because given that the delta is 0, at least for small changes in small time intervals, there will be no impact on the value of my portfolio. And I could do the same thing with the gamma of the portfolio. So I have determined the gamma of my portfolio, I assess it, I may say, well, I think that's a large value, and then as a next step, you may say, well, let's add options to my portfolio in such a way that I'm going to change the gamma of my overall portfolio. That's always possible, of course. And by doing this, by adding then options to my portfolio, I could change the gamma maybe to a lower value or maybe to 0 even. If that happens, if the gamma of your new constructed portfolio, which is constructed by adding additional options to your portfolio, is 0, then it means that even if there are large changes in the underlying stock price, the value of the portfolio will not be sensitive to that. At least if I look in a small time interval and for not dramatically large changes in value. And I could go on like that. I could have the same story for the Vega, I could have the same story for the Rho, etc. So what happens in practice? In practice, what happens is that traders, at least, they make certain that, that at least once a day, so usually, let's say, at the end of the day, they try to make their portfolio delta neutral. So what that means is that they're going to determine the deltas of all the individual securities in their portfolio. Then they're going to add them up. That gives me the delta of the portfolio. And then they are going to say, well, how should I alter my portfolio? How much underlying securities, underlying assets should I add or short sell in order to arrive at a portfolio which has a delta of 0? Because then at least I can sleep well at night, because in the morning, if I wake up again and the stock price the underlying stock price has changed in value, my portfolio was delta neutral, so my portfolio will not be sensitive for that change in the underlying stock price. So the priority always, with managing the risk of the trading book, is making sure that the delta is close to zero at least once a day. And then when there is opportunities, you could also see if you could improve the gamma or the vega. Say, well, so I still want to have my portfolio delta neutral, so that's the primary focus, but if on top of that I could also make it either gamma neutral or vega neutral, I will do that. You cannot do that by using the underlying stock, because the gamma and the vega of the underlying stock are zero, but you could do that by adding more options to your portfolio. And I will give an example a little bit later. Also, if you look to hedging strategies, then hedging a portfolio of 10,000 euros or hedging a portfolio of 50 million euros means that you have to apply the exact same principles. So really what happens is that it's, say, as a fraction of the portfolio size, the hedging costs, so the cost that it takes to engage into strategies to mitigate the delta exposure or the gamma or the vega exposure, become less and less expensive. And that's also, of course, why it's attractive for a market maker to do this, who can do this at competitive rates, where, for example, an individual investor would find it far more expensive to do that with his own smaller portfolio. So, I already mentioned it before. Suppose that you have determined the delta of your portfolio by adding up the delta of all the individual securities that are in your portfolio. That gives you the delta of the portfolio, which I denote with delta capital pi. If I want this portfolio delta, I want to make it neutral, then what I'm going to do is I'm going to add small n assets to the portfolio of the underlying security. The delta of the underlying security, I denote that with delta capital S. It's equal to 1, because the partial derivative of the underlying stock with respect to the underlying stock is 1. So adding to the portfolio means that I get a combined delta of the delta pi that was already available, plus n times the delta of the underlying security, which is 1. And making the portfolio insensitive for small changes in the underlying stock means that I want to make the portfolio delta neutral, which means, say, that the delta of the existing portfolio plus n times the delta of the underlying securities that I add should become equal to 0. Well, what should you do? You should buy, or you should add, minus delta pi number of underlying stocks. So that the minus sign could mean that you have to sell, short sell underlying stocks if the delta is positive, and if the delta would be negative, then you have to, of course, buy additional stocks. Once more, so this is a strategy to make your portfolio delta neutral today, instantaneously. What we saw in the earlier examples is that as time passes on, the risk sensitivities change due to changes in underlying market variables. That means, amongst others, that also the delta of all the individual options will change. That means that the delta of your portfolio will change, and that means, of course, that the delta of your portfolio is no longer 0, which means that you are exposed again to changes in the underlying stock price. So if you want to mitigate it again, so you do that once a day, so that at the end of the day you're going to judge again how many underlying stocks should I add to my portfolio to make the portfolio delta neutral again. So then you apply the same recipe that I just mentioned, and you apply that over and over again on a daily basis to every time arrive at the delta neutral portfolio once a day. And this regular rebalancing of your portfolio to get your portfolio delta neutral, we call that dynamic hedging. So you cannot simply hedge and forget, say, well, there's a risk, let's install a hedge, and then I no longer have to look at it. No, every day, again, you have to reassess the risk sensitivity, and you have to take action to make the portfolio neutral again against a risk. Dynamic hedging. So we saw a minute ago how you could very easily make a portfolio delta neutral. So is it also possible to, in addition to make a portfolio, to make it delta neutral, also to make it gamma neutral, or for example, vega neutral? Well, we said that if you want to make a portfolio delta neutral, it is sufficient to add the underlying asset, a number of underlying assets to the portfolio. Or you could, of course, also add other options, because options also have a delta. And then if you would find in a smart way a number of options, that you could also mitigate the delta, but usually we use the underlying stock. If you want to make a portfolio on top of that gamma neutral, then it's not possible to do that just with the underlying asset, because the underlying asset has a gamma of 0. The underlying asset also has a vega of 0. Because these partial derivatives are both 0. So that means that if I want to make my portfolio both delta neutral and gamma neutral or vega neutral, I need also other options to be included to arrive there. I cannot simply do that only with the underlying asset. And I made an example here. So suppose I have a portfolio which is delta neutral and which has a gamma of minus 5,000 and which has a vega of minus 8,000. So I'm going to look if I could add a number of assets to my portfolio and a number of options to my portfolio. So that's denoted with small n assets and small n options. And I want to do that in such a way that the portfolio is both delta neutral and, for example, gamma neutral, or delta neutral and vega neutral. So I first then added also the risk sensitivities for the underlying assets. The delta is 1, the gamma is 0, and the vega is 0. For this option in particular that I've selected, the delta is 0.6, the gamma is 0.5, and the vega is 2. Now what I could do is I could set up a system of equations. If I want to make the portfolio delta neutral, I simply have, so I want to have a new portfolio which is also delta neutral. Then I have the existing delta of the portfolio, which is delta neutral of 0. I add n assets to the portfolio with a delta of 1. So I have then 1 times a number of assets. And I add n option to the portfolio, which I should multiply with the delta of the option of 0.6. So in my new portfolio, where I add the number of assets and the number of options, the delta of my portfolio is determined by looking to the combined effect of these 3 elements: the portfolio, the number of assets that I add, and the number of options that I had. If I want this to be delta neutral, then the sum of these 3 need to be 0. If, in addition to that, I want my portfolio, the new portfolio, to be gamma neutral, I start with the current gamma of the portfolio, which is minus 5,000, and I add to that the number of assets times the gamma of the assets, the underlying asset, which is 0, of course, so this variable is not relevant, and I add the number of options times the gamma of the option that I add, which is 0.5. So the combined effect of this says, well, based on the number of options that I add to my portfolio, I calculate a new gamma, and if I want the portfolio to be gamma neutral, I need to assure that minus 5,000 plus 0.5 times the number of options is equal to 0. So that would mean that the number of options should be 1,000 if you want to achieve a portfolio that's gamma neutral. If instead, or on top of that, I want to have a portfolio that's also vega neutral, I start with the existing vega of the portfolio of minus 8,000. I add to that the number of assets that I add to my portfolio times the vega of these assets, which is 0, so the number of assets are not relevant for the new vega. And I add the number of options that I add times the vega of the option of 2. So what it means is that if I want to make my portfolio Vega neutral using this particular option, minus 8,000 plus 2 times the number of options should be equal to 0, because then the portfolio is Vega neutral, which means that I have to add 4,000 options. So we have a system here with 3 requirements and 2 degrees of freedom. So I have the number of assets, underlying assets that I can choose, and the number of options. So what I usually could do, I could only satisfy 2 of the 3. So I could, for example, make the portfolio delta neutral and gamma neutral, or I could make it delta neutral and Vega neutral. And dependent upon what I do, I first choose the number of options to make the portfolio gamma neutral. So in the first case, gamma neutral means that I have to add 1,000 options to the portfolio. So then I also need to substitute that in the delta neutral equation, which means that I need to short 600 assets in order also to get the first equation 0. So we spoke already a couple of times about dynamic hedging. Dynamic hedging was necessary because the risk factors, the risk sensitivities, the Greeks, they change as the underlying market variables change. So once more, we cannot pursue simply a hedge and forget strategy, but we must frequently adjust the hedge. So I'm going to present an example of the dynamic hedging strategy. And really what dynamic hedging strategy means is that every day I borrow or I lend money, and with that money I sell, well, if I lend money, then I will be selling the underlying assets, but if I borrow money, I will be buying the underlying asset. And I will use this combination of borrowing money and buying underlying asset, or lending money and selling the underlying asset. I will use this strategy on a daily basis to replicate as good as possible the value of the underlying call price. Really what I try to do is every day, by using this strategy of borrowing or lending money and then selling and buying the underlying asset, I try to make the portfolio on a daily basis delta neutral. If I do that, as we will see, then the original call price is almost exactly sufficient to hedge away the delta risk of this call option. So we will see that it doesn't matter what kind of scenario path will realize. So I have 2 examples. One example where the option arrives in the money, and another example where the option gets out of the money. And we see in both cases, if I delta hedge my call position, then exactly the value of the original call is exactly consumed to pursue this hedging strategy. So why dynamic hedging? Dynamic hedging because, again, the trader first gets engaged by earning bid and ask spreads because it actively trades in the market, so it picks up, spreads there. But it also needs to manage its risks, and managing the risk it does on a daily basis by reassessing the hedging strategy, hence dynamic hedging. In this example, we look to a position that the trader has, and this position is that he, on a net basis, he has been selling 100,000 call options on a non-dividend paying stock. So he is actually short 100,000 call options, so he has the obligation to deliver in the future if the call options will be exercised. And what he has done, which is advantageous, of course, is that because he has sold the call options, he has received an initial premium from the buyer of the call options, and this money is now in his cash account. So what will happen is that this money will be in the cash account and it will be accumulating against the risk-free rate. and in the end I will have a total amount that I will use to buy perhaps stocks to deliver at maturity. So then on top of that, on a weekly basis, we borrow money to buy the underlying assets, and we buy a particular amount of underlying assets, exactly the amount of assets that we need to make the portfolio delta neutral on a weekly basis. And then if we come at maturity, if the option ends in the money, then we will deliver the assets, and if it's out of the money, we will not. And as I said before, there's two examples here. One where the option follows a scenario where it will land in the money, and one where it will be out of the money. So let's look to the example. So the same option as you saw before, and then let's look to the table first. The first column says the week, so this option has 20 weeks until maturity, and then in every line there is the representation of a week. So in week 0 the stock price is 49, and in this scenario 1 week later the stock price is 48.12. In 2 weeks from now it's 47.37, and so on, and then after 20 weeks in this scenario the stock price will be 57.25. The exercise price was 50, which means that the option ends in the money in this particular scenario. So what I also do is that I determine the delta of the overall portfolio based on the stock price that's there. And we know that the delta of the underlying portfolio we use for the call options, we use the ND1 formula for that. And given that we have 100,000 call options, it also means that we need to multiply that delta with 100,000. So we need to have an amount that we borrow in order to buy these underlying assets to make the portfolio delta neutral. If we do that, so every time we're going to reassess the position of the portfolio, so we're going to say, well, these 100,000 call options that I've sold, so what is the delta, say, in the new week, and how many shares do I need to purchase or sell in order to make the portfolio delta neutral again? So you see in the fourth column that sometimes I need to buy assets, sometimes I need to sell assets. But overall, as the stock price increases further and further, I'm going to buy more and more assets, so that in the end, if the option ends in the money, and that's what you see when you look to the cumulative share purchased, you see that as the stock price increases and it becomes more and more certain that the option will, say, realize in the money, and that the 100,000 shares need to be delivered, you see that the cumulative shares purchase moves closer and closer to the 100,000, and in this particular case, after 20 weeks, indeed, there is 100,000 shares available to deliver these options. So what happens at maturity, at time 20? So there is the money that has been borrowed, and because money is borrowed, you also have to pay interest on that. So every week we calculated the accumulation of the money borrowed times the exponent, the risk-free rate, times the 1 week time period. So these interest rate costs are added to the cumulative cash outflow, which means that after 20 weeks, there is a total amount of 5.263, 2.42, 5.2 million basically, which has been borrowed, which has been a loan. And with this loan, underlying assets have been bought, and at maturity, because the stock price is 57.25, these 100,000 assets that have been bought have a value of 5.7 million, more or less. You have to pay the option value at maturity because the option ends in the money. Exercise price was 50, so if the underlying stocks is 57.25, it means that it ends 7.25 in the money, times 100,000 is 725,000 that need to be paid by the trader. And there is the cash account where originally you included the option premium of 2.4 times the 100,000 calls that you have sold of 240,000 euros, which accumulate against the risk-free rate, which in the end are 244,000. So if I add all these elements up, so I sell the shares 5.7 million, I pay off the loan of 5.2 million, I pay off the value of the option because I have taken the short position, which is 725,000. I take the money from my cash account, the original premium, which has accumulated 244,000. Then the net result of that, so after 20 weeks, is that I am minus $18,000. And if I look to minus $18,000 on, say, such a huge portfolio, I say, well, that's almost equal to zero. So what it says is, well, the option premium that I have received of the 240,000 euros, it's almost enough to pursue a delta hedging strategy in such a way that after 20 weeks, so I will have a strategy pursued which I basically with no loss or a very limited loss can cover the risk there. And of course, so what a market maker will do is it will not simply ask the call price, but it will ask a little spread also to take care for these say inaccuracies that are still there. Now I'm going to do the very same thing with the very same call option. So again, the market maker has sold 100,000 call options with an exercise price of 50, the example that we have used before in this lecture. Also again, we're going to look to another 20 weeks. So at each week there is the stock price that develops. It starts at 49, then it first moves up, and then in the end, after 20 weeks, it realizes a value of 48.12. Well, with an exercise price of 50, it lands out of the money, which means that the option will become worthless. So what will happen is that the trader will pursue on a weekly basis a delta hedging strategy. So it means that it looks to the delta of the portfolio and then adds shares to it to make it delta neutral. So we determine the delta of the portfolio by looking to the delta of the individual option, and we multiply it by 100,000. To make the portfolio delta neutral, we take exactly the opposite position of that in the underlying stock, because we saw in an earlier example, that's the way how you make a portfolio delta neutral. So you have to buy shares, and these shares are bought by borrowing money. And on the money that I borrow, I also pay interest. So what happens is that over time, every week, we determine again the delta of all the call options, and then we see, well, how many of the underlying assets should we add to the portfolio or take away to have a portfolio that remains delta neutral. So if we look to the column which says cumulative shares purchased, we see that initially we have 52,000 shares purchased. That goes a little bit up, even to 70,000 shares, so which happens if the option at that moment is in the money. Then afterwards we see that the number of shares that accumulate go further and further down, because it becomes more and more clear that the option will, in the end, land out of the money, and then in the end, after 20 weeks, there is no shares in the portfolio because there is no need to deliver the underlying assets. Also, the value of the call option then realizes a value of 0. and the cash account, so where the original premium that was received because the market maker, the trader, sold these call options against a price of 2.4 times the 100,000 number of calls, accumulates in a cash account against the risk-free rate, and then at maturity time has a value of 244,000. So if I look to what happens at maturity, I have no shares, so I also, if I look to the shares I have, they have a value of 0, so there's nothing to sell, but if I would sell nothing, then I get a value of 0. I need to pay off the loan, so which is primarily the interest rate cost that remain, $256,000. The option value is 0, so I'm short the option value, but it will not be exercised, so I don't have to pay anything. And I have the value of the cash account, which I can now consume. If I add all these elements up, then again I say, well, by pursuing this dynamic hedging strategy, I see that the option premium that I received in the beginning is almost exactly enough to mitigate the risk that arises over the life of this option. Because net I arrive at minus 11,000, which is almost 0 in the context of these larger numbers. And of course also what the trader will do, given this inaccuracy, the price that it will quote in the market will be a little bit higher than the Black-Scholes price. So I think this is a very nice example to see how in a dynamic way traders will manage their trading book over the life of the option, and that also concludes the session of today. Thank you for your attention.